going back to 1950 or so. So seasonality is involved, but also the believability of equities are back in terms of it working, and the believability of the U.S. markets to have some wherewithal is also back.
So I have a little bit of an issue with the Goldilocks moniker. Can you have Goldilocks with stocks not only at record highs, but with valuations where they are to historical averages? I don't know. Is that Goldilocks?
Well, Goldilocks is the notion of interest rates staying steady, earnings growth being positive, GDP growth being positive. Doesn't have a valuation metric to it traditionally, but I think that we're heading back. And I was a strategist back in 1995, 96. I think we're heading back into that era again, where toward the end of 96, you started to see a broadening out of the market away from just the consumer staples, high multiple stocks. So remember, too, that the multiples peaked in the 30s during the tech wreck of 99, 2000, really into 2000. So I think we got a long ways to go. I don't think we're anywhere, any kind of bubble territory for tech.
Inflation's higher than target. Can that be Goldilocks?
Well, inflation, I think...
Stagflation is a word that's tossed around. Is that Goldilocks?
It's an excellent point, and I think of the one thing that we need to be worried about is that if the Fed cranks interest rates down too fast, could that ultimately be something that would feed inflation? Remember a year ago when the Fed started cutting, 10-year Treasury went up, yields went up.
Oh, well, I have news for you. The long end of the curve has been up since the Fed started cutting this year.
Yeah,
just
so
now.
We actually think the yield curve is going to continue to steepen, and that'll be good for financials, and that's where a lot of the earnings growth is going to come out. But also, ultimately, that will help drive participation to broaden into small cap, into value, and the like. I think it's going to be, right now, I'm not going to give away my forecast for 2026 so far, but I think it's going to be really difficult.
Oh, you kind of already did.
No, I didn't. It's going to be right now. Goldilocks in a consistent kind of more normalcy type pattern, Scott, doesn't mean up 20 to 25%. I think it's very, very possible that we're going to enter into a period where stocks are up high single digit to low double digit, especially with the dividend. So let's call it near the historical average of 10 to 12%.
High single digit, but if you include the total return and all of that, you're better than that. But why only single digits? Well, I think the environment's so great.
No, I think you have to underpromise and overdeliver, and I think the market has to prove itself, and the Fed has to prove itself in terms of how they're going to engineer this in the turn with respect to the dual mandate, and we'll see from here. But ultimately, especially when we're taking a look at the consensus numbers that we see from economists, but also our great economics team at BMO, interest rates are going to tighten in. So that's why we think what we think in terms of where we're going to go.
All right, hold your thought for just a minute. We're going to do this breaking news now with Leslie Picker, who has that for us. Leslie, what do we know?
Hey, Scott. In this closely watched trial of Charlie Javies, this is the entrepreneur who was convicted recently of defrauding J.P. Morgan into buying her college financial aid startup known as Frank for $175 million. Well, she was just sentenced to about over 7 years in prison. This was handed down at a hearing in Manhattan federal court just moments ago. The 33-year-old was convicted about 6 months ago on all 4 counts she faced, which was bank fraud, securities fraud, wire fraud, and conspiracy. She pleaded not guilty and is expected to appeal her conviction. J.P. Morgan declines to comment on the sentence. Scott, I'll send it back to you.
All right. Okay, Leslie, thanks for that breaking news for us. Just make the point that you were making again when I was sort of rushing you to finish because I had to get to that about the Fed.
Yeah.
The role that the Fed plays in next year and why you think it could only be a single-digit return kind of year.
Well, I think, again, I think that's kind of the bottom end of where we think we could be. And I think the Fed has to build some credibility back with the market, especially considering all of this tenseness with respect to the White House, but also what you mentioned in terms of inflation. Now, we have seen inflation be stickier than everybody thought, including ourselves. So I think that the Fed has to kind of thread the needle here a little bit. We ourselves didn't think the Fed was going to go 50 like most people thought they were. And I do think we're probably going to see at least 2 more cuts before the end of the year. I think if we are more aggressive than that, I think then the inflation thing comes back into play, especially if it hasn't fallen.
So let's bring our senior economics correspondent, Steve Leisman, in. We'll come back to this in a minute. Just plays right into some of the Fed speak that we've gotten today. Last week was busy with that. Of course, we got the Fed chair, and then we had a social media post over the weekend from the president, which has rekindled the whole conversation around the Fed chair's term.
Yeah, the "You're Fired" cartoon. I'll get to that in a second, but I want to talk about the actual Fed speak today. Scott, they really broke along and kind of between the new fault lines on the committee, which is those more concerned about tariff inflation, those more concerned about a weakening job market. St. Louis Fed President Alberto Musalem, kind of on the hawkish side, but saying he's open-minded to future cuts, but the Fed needs to be cautious here. Tariff inflation is going to play out over the next 2 to 3 quarters. Policy could soon be too loose if the Fed isn't careful, and the labor market weakening is a greater risk. You know, Fed President John Williams saying inflation ex tariffs is around 2.4%. That's lower than it was in the past. So he sounds okay with the inflation rate and kind of excusing the tariff inflation. Fed is still putting downward pressure on inflation, and the neutral rate around 1%. That's real or inflation adjusted. Hasn't changed much in his opinion. Take a look at the probabilities. Still on course, or lots of confidence in an October cut. Maybe a little less than it was, but still confident in the second cut in December there. Earlier in the day, Cleveland Fed President Beth Hammack, one of the more hawkish people out there, gave a more cautious speech about rate cuts, emphasizing, Scott, the Fed's continued missing of the 2% inflation target, which you were just getting on with Belsky about.
So, but Belsky's not over his skis by much at all if he thinks 2 more cuts this year. The market obviously more sold on October than later, but nonetheless is still 2/3 leaning towards 2 cuts.
Yeah, I haven't often seen Brian out over his skis. It would be an interesting sight to see, I'd point out.
He is from Minnesota, so I don't know what it looks like, but
that's where the market is. Brian is right there. And it becomes a question of next year. It becomes a question of the extent to which the Fed says, hey, it's going to be another 1 or 2 years till we get to that 2% target. It's going to be a question, Scott, I would watch this notion of the ex-tariff inflation rate. You had some people come forward like Waller and Bowman have talked about the ex-tariff inflation rate. Jeff Schmidt from Kansas City said that's the dumbest thing I've ever heard of. Well, not quite in so many terms, but he said he would never use such an indicator. And then you have Williams there saying, hey, if I look at inflation without tariffs, 2.4%, it's lower than it was. It's going the direction I want it to go. People watching that. So that's a really important aspect for the Fed to look at, whether or not they decide that, hey, I don't, Powell says, I don't want to be Arthur Burns. I don't want to leave with an inflation rate that's above target and rising. He may decide that next year is more cautious than the market has penciled in right now.
I mean, speaking of not wanting to leave, presumably he doesn't want to leave before his term is up into next year. Any reaction whatsoever from the Fed regarding that cartoon that we talked about the president posting over the weekend?
No reaction. But, Scott, I would say investors need to watch carefully what the Supreme Court decides on Lisa Cook. If the Supreme Court gives the president leave to fire Lisa Cook, depending upon how they do it, if they do it, it might embolden the president to try to make a change at the level of chair before it's time in May.
Steve, thank you.
Pleasure.
Our senior economics correspondent, Steve Leisman. I'll just come back to you for a comment. How are you thinking about all of this, whether Chair Powell serves out his whole term, whether he gets fired, whether the Supreme Court sides with the president over Lisa Cook, whether that is a market change in how you would think about Fed independence and whether that's a negative for the market? You tell me.
I think it really it really forces us to be focused on large cap stocks that add some sort of liquidity to it because of the way the market's going to be volatile. And so what happens when volatility increases, we go right back into large caps. You've heard me talk about.
You saw the cartoon over the weekend, right?
Yeah,
let's put it back up there because we didn't show it before. But let's put it back.
Yeah, so
if the president fires Chair Powell, what does the market do?
Well, I think there's going to be some volatility. We'll probably see some sort of a sell-off. I think that's why you're going to have still an inherent bid in large cap stocks, Scott. I mean, you've heard me talk about the broadening out and value and small cap. But at the end of the day, when people are nervous about the market goes down, they're going to buy large cap. So what's large cap? It's going to be
mega caps.
It's going to be the mega caps. It's going to be the Magnificent Seven or whatever they are at that time. So I think that really, I mean, we've said this for about 10 years. The new consumer staples are tech stocks and communication services stocks. And again, going back to the early 90s, that's what really worked coming out of the commercial banking crisis in 94 into the Goldilocks period where Greenspan was cutting, and then it was off to the races in the late 90s.
All right, let's continue the conversation with New Edge Wealth's Cameron Dawson. and Northwestern Mutual Wealth Management's Matt Stuckey. It's good to have you both. Cam, your thoughts as you sort of take everything into context here.
Yeah, so when we look at this market, we think it's being driven by the fact that liquidity remains still extraordinarily abundant. You have earnings estimates that continue to make new highs. And so when you put those two things together with the fact that institutional positioning is still fairly light, we think it's one of the reasons why you are seeing this chase in September, which is usually a weak seasonal month, is that if you look at discretionary institutional positioning based on the Deutsche Bank survey, it's in just the 44th percentile. So there are still a lot of people who've sat on the sidelines of this market. Now, that doesn't mean that all places are light in positioning. Households look to be very fully invested. Household sentiment looks to be getting a little bit frothy. Valuations, we know, are high, but they're a poor timing tool. So those are all things that we'll have to contend with as we go into 2026. But for now, you get this gravitational pull upward because of liquidity and earnings and positioning.
Well, it's an interesting point. I mean, Brian referenced all this cash on the sideline. Whether you really believe that cash is going to come into the market, as I bring it back to the very beginning of the show, at record highs, right? People look at that. Valuations are rich, stocks are at record highs, rates aren't going down in a really meaningful way, so you're still getting paid for cash. Maybe you're going to miss out some on the stock market, but that doesn't sound like the environment where you're going to get a dump truck into the stock market.
It's hard to look at the high cash balances in money markets, $7.4 trillion that we all know about, and think that that is absolutely fungible into equities. You look at the AAII survey and the Fed Flow Fund survey that looks at stock allocations by households, and they're all at near records, which just suggests that households are fully invested. Yes, will some of the money move back into the market? We have clients that are still sitting on cash that wants to get invested and wants to buy every single dip. But when we look in aggregate, it does look like households are fairly well invested. And the important point here is when you are so allocated or exposed to equities, it means that the consumer is very sensitive to equities as well, because that high-income consumer is what's been driving a lot of the consumption growth in the economy, and they hold the most of the equities.
How would you address that?
Well, she nailed it on the biggest thing. The biggest takeaway from what she said is it's two different markets. It's the institutional market that doesn't trust anybody. They're negative. We can read surveys till we're blue in the face, but you know how you get the best information? By talking to an institutional client, looking in their eyes, based on their questions. They are bearish. They're worried about Trumpy. They're worried about the Fed. They're worried about the market that they missed since April. They've massively underperformed since April. When you're talking to high net worth and wealth clients or family office clients, they want to put cash to work. They want to buy the dip. Not too dissimilar. This has been a trend going on for the last 10 years, but it really started to exacerbate in 2020. I had a call with the institutional client today. Massively underperforming, super worried about the fourth quarter. They've missed the move, and so they really want to know how to position going forward.
Matt, what are your thoughts as we kick this all around?
Look, I mean, I think to me, one of the most encouraging parts of the market that I've seen is just the broadening out of earnings estimates increasing across the board. And, I'm just looking at kind of what's happened since mid-May. It's not just been a large cap story that we've seen the last couple of years in terms of the Magnificent Seven driving earnings higher. It's been things like small cap, mid cap, equal weighted S&P, kind of all rising at the same pace as we kind of got through the second quarter and saw that, coming off the first quarter's earnings reporting season, things were much better than expected. Then you add on top of that, the Fed is starting to ease, and we think that they're going to continue to ease throughout the rest of this year. That adds some fuel to the fire that some of the rotation and broadening out of the market can continue into next year. And so, it's important to be optimistic when there's good evidence to be optimistic. And this is one area that we're pointing to and saying, this can continue on. However, I would say, we still are a little bit cautious towards valuation here. 22 and a half times forward earnings for the S&P 500 isn't going to be a catalyst to the downside, but it does limit, we think, a little bit of the upside as we think forward in the next 12 months.
But you're making the case for the broadening story. You still have faith in it. Because I like when, it's a kind of a pushback a little bit on Brian, who suggests, well, if things are uneasy, you're just going to go back to the tried and true and buy the biggest stocks in the market, like the Mag 7, because you can play some offense, you can play some defense in that area.
I think what's interesting is you go through history and you look at how long large caps can continue to fundamentally outperform things like mid cap and small cap in terms of generating the types of superior earnings growth that we've seen from other asset classes. And that's actually a little bit less than a lot of people think. And you go back 20 years and look at 3-year rolling time periods of earnings growth for things like mid caps versus large caps. About 90% of the time, mid caps have generated superior earnings growth. And so what we've seen the last 2.5 years is somewhat of an anomaly in my eyes. And we think that continued easing from the Federal Reserve is likely to continue on the broadening of earnings revisions trends that have been so positive since mid-May.
Let me make this clear, too, for our viewers. I mean, your top holdings are as follows. NVIDIA, Microsoft, Alphabet, Apple, Amazon, Meta, JP Morgan, Lilly. I mean, you are a large cap believer. Obviously, you're putting your money in those places. So that says a lot about where you think this market's going to go.
Yeah, that's right, Scott. And we do certainly value the quality profile of these companies. They're extremely cash generative. They generate very high returns on capital, and we think that's going to persist. But that's not the only area to continue to allocate within the portfolio. It's just been exciting to see, and it's a breath of fresh air as a portfolio manager to see more opportunities look more positive from a fundamental perspective as we look to deploy new cash.
We're going to get into earnings, Cam, soon. Right? I mean, it's hard to believe we're going to be talking earnings again. Is that just going to underscore why it's prudent to be bullish like Brian is?
Well, we got that huge earnings upside surprise in the second quarter. And so the question is, do we get a repeat of that again? And if you unpack that earnings surprise in 2Q, it came from the fact that tariff costs hadn't hit companies yet, came from the fact that you had pull forward of tariff demand, and you had big upside surprises in the banks. And that was a critical big upside driver. But when we look at the earnings story, we actually think that the broadening out is an absolute myth. You don't see it in equal weight earnings. They're continuing to get revised lower. Russell 2000 continues to get revised lower, which is why we think that relative performance continues to hit new relative lows for those indices versus large caps. So until we actually see those things start to turn higher, earnings revisions start to turn higher, this will remain a narrow market.
Matt, you want to come back on that?
Yeah, I mean, that's been the story the last couple of years. We would just wonder whether or not the economic expansion can continue at the pace that we've been more excited about recently, if only this narrow slice of the economy can continue to grow at these levels. We think it's a question of whether or not this K-shape can continue. And to us, I think there's a little bit more of an expiration date associated with that type of economy versus one that's more broad-based. And so for us, we think it almost has to continue to broaden out for the market to continue to rally into next year and beyond.
What do you think?
Well, I think 10 years from now, Scott, let's make a bold call. I think
10 years from now?
10 years from now when, you're running everything here.
And then you have a 40-year career that you can reference instead of 30. No, that'll be something, won't it?
No, listen,
my 40-year career.
My 45 years on Wall Street.
Well, you drop the 30 reference all the time.
Yeah,
so what do you
35.
In 10 years what?
I think we're going to be kicking ourselves if we did not own more small mid-cap stocks. I mean, we run a small mid-cap portfolio. It's one of our best absolute performers. But I don't think the Russell's the right index to be looking at. If you look at the S&P 1000, which is the 600 and the 400, I've never seen in my collective career, I'm not going to tell you how long, the type of free cash flow, return on equity, consistency of earnings in the small mid-cap space, and some of them are paying dividends. And so I think as we kind of continue to move on in the market, I think that's going to be a great place to be.
Okay, we'll make that the last word. Brian, thank you. Cameron, thanks to you as well. Matt, we'll see you soon. Appreciate having you. Let's send it now to Steve Kovac for a look at the biggest names moving into the close today. Hi, Steve.
Hey, Scott, I got a few for you here. Trading on Wolf Speed, it's halted multiple times today after that stock soared over 1,000%. That comes after the company filed an SEC form to delist its securities in the wake of its exit from Chapter 11 bankruptcy protection. Meantime, retailers Etsy and Shopify, they're popping about 14% and 6% respectively after OpenAI announced its new instant checkout feature. OpenAI says it will allow users to buy products through ChatGPT from U.S. Etsy sellers, with more than 1 million Shopify merchants also coming soon. And Carnival shares, they're falling over 4% after initially popping on earnings this morning. The cruise line raised its annual profit outlook on strong demand, higher ticket prices, and more onboard spending, Scott.
All right, Steve. Thank you, Steve Kovac. We're just getting started here. Up next, two pops and a drop The three big stock stories on our radar today should be on yours as well. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC.
A lifesaver.
We're back with three big stories in the markets today, starting with the biggest LBO ever. Steve Kovac is back with news sending shares of EA higher today. What do we know?
Hey there, Scott. Long time no see. Well, this deal that we heard about today with Electronic Arts, it comes amid a slump in gaming growth. Take a look at EA's annual revenues over the last 5 fiscal years. It's been relatively stagnant those last 3 years coming out of the COVID pandemic. The rest of the gaming industry looks pretty similar. And the stock is up only 56% in that period. That's lagging behind the S&P, which is up 100% in that same time. Now, the Saudi Public Investment Fund is the big investor here and the biggest owner, and it continues to amass a gaming empire. It also owns 6.2% of Grand Theft Auto maker Take-Two and 4% of Nintendo. And on the mobile side, it bought Pokemon Go and the parent company of Monopoly Go. Now, this is not a done deal. EA has 45 days to solicit other offers before taking this one. And Clay Griffin, he's an analyst on gaming over at MoffettNathanson. I caught up with him earlier today, and he said potentially Take-Two Interactive could swoop in here with a better offer, though the market today is not acting like that's an option. He also says the gaming space is already consolidated, and there aren't too many public players left, Scott.
Oh, we'll watch. I mean, it'll be interesting to see what, if anything, happens. Steve, thank you. Steve Kovac. Now to Robinhood shares. They're also sharply higher today. Mackenzie Segalos following that money for us. It's a big, big mover today.
Yes, it is, Scott. It has been a blockbuster run for Robinhood. It's up threefold year to date, and shares are jumping more than 10% on the day, on track to close at a record high. Now, this rally follows a new milestone for the company. CEO Vlad Tenev saying earlier that Robinhood's prediction markets have now crossed 4 billion event contracts traded, with more than half of that volume happening in Q3 alone. Prediction markets let users wager on those yes or no outcomes, from Fed moves to sport results. And the fast-growing business has drawn investor buzz, but also regulatory scrutiny for blurring that line between investing and gambling. Investors are also digesting news out late Friday that Robinhood has started rolling out banking services meant to mimic luxury private banking. It is part of that broader push to become a full-service financial hub and potentially replace the need for a traditional bank account. Scott?
You know, it's interesting. We're doing this story, and our Max Myers was pointing out to me that Robinhood's market cap is now slightly larger than KKR's, which had me thinking back to when PayPal had, just a few years ago, had a bigger market cap than Bank of America. It just shows you the fervor behind some stocks that have a sort of cult-like personality for a while. You could also look, Mac, at crypto's big comeback now today as helping these shares of Robinhood.
Yeah, and I mean, just think back to this summer when Robinhood cleared that $100 mark. It was pegged to this exposure to tokenizing private equities when they said that they would be offering shares of SpaceX and OpenAI. And that's something that Vlad Tenev has really been using as part of his push this year, the crypto ambition. So certainly seeing alignment there.
All right. Story number 3. Mac, thank you. Finally, shares of Williams-Sonoma selling off today. Courtney Reagan joins us now with those details. Hey, Courtney.
Yeah, Scott. So President Trump posting on Truth Social this morning that he will be imposing substantial tariffs on any country that doesn't make its furniture in the United States, but then give no further details, at least not now. This, of course, does follow the president saying in late August that he's investigating new tariffs on furniture imports, and then last week announcing a 50% tariff on kitchen cabinets, bathroom vanities, and, quote, associated products, and then a 30% tariff on upholstered furniture starting October 1st. Last week, furnishing-related stocks or even home-building stocks, they held up a little bit better than they have today. KeyBank analyst Bradley Thomas estimates 20% of Williams-Sonoma sales are upholstered furniture, 18% of which are sourced in the U.S. So that means the rest are imported and may be subject to these tariffs. Now, the firm estimates that RH upholstered furniture business is as much as 40% of its sales, though a bigger portion, 20 to 30%, is made in North Carolina currently, and they have a goal to increase that over time here. Now, Ethan Allen and Lazy Boy, a little bit more insulated with much of their manufacturing either here in the United States or in North America, and thus compliant with USMCA, and so would not subject to these potential tariffs. But again, we still don't have a lot of the details. And so it's interesting, Scott, when you see sometimes these stocks selling off like today, whereas last week, Home Depot and Lowe's didn't really move much. And I know for a fact they sell bathroom vanities and they sell kitchen cabinets too.
Yeah, well, one day's activity doesn't a story make, really. So we'll have to see what happens in the days ahead. Thanks. Courtney Reagan. Still ahead, why the cannabis stocks are shooting higher in today's session. The bell's coming right back after this.
tradingview.com.
Coming up next, the big debate over an AI bubble. Have we come too far, too fast? Deepwater Asset Management's Gene Munster standing by. He'll give you your take next.
Pitch.com.
Welcome back. Is history in danger of repeating itself, or at least rhyming, as the current AI craze has some hearkening back to the dot-com crash of the late 90s? Too many stocks up too far too fast on the promise of riches down the road. We all know how that ended. Gene Munster, managing partner with Deepwater Asset Management, joins us now. How do you think about that question? Are we at least rhyming?
Well, I'm always looking for the rhyme, Scott. Of course, we're never going to see it perfectly mapped to what happened 25 years ago. But I want to first kind of mark where we're at, mark the moment here. This is a big week. That since GPT made its debut in November of 22, the Nasdaq's up 100%. typically over that period it would be up like 25%. So this conversation is most appropriate. And the reason why these bubbles happen is outlandish behavior starts happening from investors. And this comment that I'm going to make may fall into that category for some people. Is that a few months ago I thought we're in the third inning of the AI build out, the AI trade. Now I think we're in the second inning. And that's based on what we've heard from the big CapEx, the big spenders, hyperscalers after the June quarter, and also more recently from Zuckerberg and CFO Susan Lee at the Goldman conference, and from OpenAI, Oracle, NVIDIA, all of that put together. Scott, I think there still is a massive amount of investment. I think that investment will lead to these valuations going higher. One other piece about the rhyming part.
Yeah,
no,
go ahead. Go ahead. Nope. Go ahead, Gene. You paused. I thought you were done. Please go ahead.
Right on. The rhyming part, one more on this rhyming part is, I think one piece that we're going to see is these companies that are so loved by the AI trade, the private companies, whether it's OpenAI, XAI, Anthropic, Anduril, none of these are public yet. None of them have seen this crazy public euphoria around it. And so at a very high level, it's hard for me to imagine that we're at the end if, in fact, we haven't seen some of these biggest companies have their breakout period in the public markets.
So you mentioned the NASDAQ up 100% since November of 22. We looked at some of the groups within the AI story. The hyperscalers, the Googles, the Metas. Meta's up 579% since November 30th of 2022 when GPT was announced. NVIDIA's up better than 1,000%. The so-called others of AI love. Dell's up 200%, Oracle 250, IBM is almost a double. The power companies that get a lot of love, utilities that are now modern-day growth companies. Vistra 725%, GE Vernova up 355%. It's why Ken Griffin probably said what he did on CNBC last week. I want you to listen.
There's obviously echoes of the dot-com bubble in this moment. All right, and let's take a step back. The dot-com bubble, there was a huge amount of capital that flowed into what today we refer to as the internet. Now, the true winners and losers were not readily identifiable at the start of that whole bubble. But move forward 10, 15, 20 years later, there's no doubt that the world was radically transformed by that moment in time.
It's interesting when he says, quote, now the true winners and losers were not readily identifiable at the start of that whole bubble. Have we decided that we know who the winners and losers are this time, or the ones that we think? And they're the names, the very names that I read off those lists to you?
I think they've been a winner. I think that there's a whole nother class of companies coming, these AI first companies. There's a handful that I mentioned, those 4 that I mentioned that are at the top of that shelf, kind of this golden list. But we spend time in our venture business and look at these other kind of emerging companies, and they will be, I think, a whole battery of $100 billion plus companies that most investors don't know about. I think this it is important to focus on kind of how narrow that trade has been, like you just described. But if in fact the impact is as big as I think it's going to be, then it's going to kind of spread out. I go back to Walmart CEO comments last week saying that AI will impact literally every job. And I pause and think, like, how many jobs are being impacted by it today? And the answer is few, very few. And so when I think about, the class of companies, I do think it's going to spread out. I think you're going to see better performance more broadly with some of these smaller companies over the next 1, 3, 5 years. I also think, again, there's this new class. We haven't seen them. We've seen a few of them. CoreWeave, Reddit, but we really haven't seen the private class. And those are the companies that are growing. If you take OpenAI, $2 billion last year, 13 this year, 26 next year, expected to be 200 by 2030. Like, that is the exciting part. And so I think until we get to that, just that kind of that breathtaking, investors can really get a solid eye on that. I don't think they're at the top. One other piece I want to mention, this is really healthy for the market. The conversation about the bursting of the bubble is, of course, healthy for the market. I remember being an analyst back at Piper Jaffray in the mid-late 90s and thinking this is going to go on forever. Like the concept of a bursting bubble just wasn't in the conversation. And I think because that was such a painful moment, I actually don't think we're going to get like a spectacular, I've described that in the past, a spectacular bursting. I think what will happen is we'll get a move in the market for the next 3 years, continued massive outperformance. But then I think it's more or less going to be more of a dip or kind of a steady, a leveling off versus this big blow up that everyone's expecting.
But bubbles bursting are always spectacular. Are they not? I mean, that's part of the point, is that greed rules everything else when it comes in part to investing into perceived bubbles. You're afraid of missing out. You continue to ride it up until the rug is pulled out, and that's why it's so often so spectacular.
I think the piece, the difference, I talk about the strength, I believe, in the market over the next few years. If not for this conversation about what happened 25 years ago, I think the market, I think the top would have been even higher. And so I do believe we're going to reach a point when it's crazy, when it's absolute pandemonium. There have been pockets of that, but I don't think it has been as breathtaking as what happened 25 years ago. I also believe that because we've been through this, we're just not going to see, to put it into perspective, is that, the average NASDAQ company back in 2000 at the peak of the bubble was trading at 100 times earnings. And right now we're at like 32. We're not going to get back to the 100. We might get back to 50 or 40 or some much bigger number, but it's not going to get back to that. And so I think the bubble is going to burst. Is the degree of the spectacularness of the burst is I think it's a helpful debate. I think this conversation is really important. But I just ultimately come back to a very simple fact. Do you believe in AI? Do you believe it is going to do what Satya Nadella said back in April? Is it is going to solve the world's most difficult problems? Hasn't even started from my perspective. I think a chat bot, a programming bot, customer service doesn't even begin to scratch the surface of its potential. And so if you believe that ultimately that future, you think about Walmart's comments, if you believe that is on the come, I think it's reasonable to believe that the market still has a few years left.
Gene, thank you. Appreciate it. Good conversation. I look forward to having more. That's Gene Munster. Up next, we track the biggest movers into the close today. Steve Kovac standing by with that. Steve?
Yeah, investors are loving the price target change to one mobile tech company, and another biotech acquisition has shares rising for one cancer treatment researcher. We'll share the names when Closing Bell comes back after this.
Sector Sort is sponsored by Sector Spider ETFs. Sector Spider ETFs. Visit us on the web at sectorspiders.com.
Good evening. You're watching the Artist Forum. My name is Ellie Fordyce, and I will be your host for this segment. This evening, I'm very, very happy to be up at Worldviews, which is a wonderful art exhibit and presentation that the Lower Manhattan Cultural Council has been putting on here at the World Trade Center, #1 building, World Trade Center. And I have with us tonight Mukhtar Kokash. And Mukhtar, can you tell us something about this program and your involvement with it?
Sure. This is actually an artist residency program. Artists apply to and are selected by a jury to be in residence on the 91st floor for a period of approximately 6 months. And it's a raw space. It's a shared studio experience for approximately 15 to 20 artists. And they get to work in this environment. Some people paint the views. Some people work on issues of corporate culture. Some people are interested in issues of scale. Others meditate and do very ephemeral works, because as you can imagine, the views are very inspiring and the light is very beautiful. This program was actually started as it is 3 years ago. However, approximately 4 years ago, an experiment to have artists in the World Trade Center was initiated by an artist called Carl Scorza, and who approached the Lower Manhattan Cultural Council about the desire to paint from the World Trade Center during the winter because it was convenient and the World Trade Center would offer spectacular views. So an experiment was carried out with the help of Graham Nixon, who is the dean at the Studio School, New York Studio School. And approximately 15 artists were selected. They painted individually in different spaces throughout both towers, and they never got a chance to meet and talk. And some people painted for a period of a week. Some others stayed for as long as 8 months. And when I joined the organization, the council 3 years ago, we tried to create a more consistent experience.
For lesson 10 from the bell, let's get back now to Steve Kovac for the stocks that he's watching. Top of your list today, right now, what?
Let's go with that beloved here, Scott, because those shares are popping today after Morgan Stanley maintained its overweight rating and increased the price target on the stock to $750 from $480. MS is bullish on the company's upcoming self-serve ad tool for e-commerce and non-gaming clients. Meantime, biotech company Merus is surging today after GenMab acquired it for about $8 billion or $97 a share. It says the acquisition will help it transition into a wholly owned model and also touted Merus's flagship cancer treatment in late-stage trials. And Galaxy Digital is higher today after it invested in a Korean entertainment tokenization platform. The platform says it will create revenue-sharing tokens and automate royalty distribution, among other tools. Scott, we see shares up 11% there.
Steve Kovac, thank you very much. Up next, the headline that has cannabis stocks rallying today. That and much more in the zone next. right, we're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Diana Olek on today's housing data, and Brandon Gomez standing by with what is sending cannabis names higher today. Diana, we begin with you on these housing numbers.
Yeah, it's got a big surprise to the upside for August pending home sales, up 4% from July. Now, this count is based on signed contracts, so people out shopping in August when mortgage rates were slightly lower than they were in July, but not quite as low as they are now. Sales of newly built homes, also counted by contracts, saw a huge jump in August. And while it's expected to be revised lower, clearly we are seeing a little more energy in the overall housing market thanks to these lower rates. Now, a survey of realtors showed 19% expect an increase in buyer traffic over the next 3 months, up from 16% last month, but fewer expect an increase in seller traffic compared with July. And we did see inventory in August fall for the first time since the start of this year. Builder stocks aren't moving much on this, a little bit higher, but perhaps everyone's waiting until that all-important jobs report Friday, if it comes Friday, that could move markets. Back to you.
All right, Diana, thanks so much. Brandon Gomez, tell us more about cannabis stocks.
Hey, Scott. Yeah, Tilray, Canopy Growth, Aurora shares all making massive jumps today. President Trump sharing a video on Truth Social last night about the health benefits of hemp-derived CBD. Now, the video said it could, quote, revolutionize senior health care as an alternative to costly prescription drugs, another area of the president's focus. Now, just last month, he hinted also at a move to reclassify cannabis from a Schedule 1 to a less dangerous Schedule 3 drug, which most notably would open pathways for medical research. Now, one lawyer I spoke with emphasizing that reclassification would ease the path for big pharma to research and seek cannabis approval for drugs. Tilray CEO Irwin Simon telling me earlier this hour as well that he is, this is about complementing, not replacing existing care. A buzzy industry, of course, Scott. Some stocks halved in value this year while others are up over 40%.
Brandon, thank you. Brandon Gomez. All right, Mike Santoli, got 2 minutes left. You're going to hear the sound effect in a minute. Your thoughts on this market today?
You know, market just finds a way. Friday was a very broad, inclusive rally, responding to macro, PCE numbers that were in line. Today, it's a little more narrow, just finding a way to let NVIDIA protect the indexes once again. Got the majority of stocks in the New York Stock Exchange down, does not do any damage to the S&P. So we can keep repeating the fact that this is a resilient tape, refuses to come in anything but the shallowest of pullbacks. Haven't had a 3% dip in a while, but you have these kind of persistent overbought readings, and everybody keeps saying, you know what, the big money is not fully committed yet. So I think we're still in this dynamic. Everyone pretty much assumes there's going to be a year-end ramp. The question is, do you get some kind of an entry point lower before that? We do have this window into October where, in theory, you have the potential for some bumps. But on a given day, either the big guys or the majority of stocks don't allow for it.
Yeah, on the resiliency, today looked like a little uneven, and it was a kind of a NASDAQ show at Tech and Com Services. And then, to your point, we did have then, okay, now the Dow's green and then everything's green. Yeah. It speaks to the kind of market we have, even though we don't know what's going to happen with the shutdown, whether, we're going to get any data this week as a result of that.
The market's talked itself out of any acute concern about the shutdown, just looking at the history. I guess that makes sense from here. I do think the market has something to prove. We did sort of knock up against 6,700 on the S&P twice last week. We didn't manage to get through it. We're still just kind of hesitating in a sideways fashion. Today, NVIDIA comes to life. Bitcoin gets a bid, and it feels as if a lot of the hyperactive stuff is moving again. Take a look at Robinhood. So we'll see if that's just a one-day phenomenon and maybe have to kind of build a new storyline going into tomorrow.
All right, good stuff, Mike. Thank you. Mike Santoli. Bell rings is green across the board, as we were just saying. I'll see you tomorrow into overtime. It's John Ford.
About AI spending. Energy is the worst performing sector as oil falls more than 3%. The market's worrying about production increases, but also oil had risen to a nearly 2-month high. And the 10-year yield sliding, the bond market squarely focused on Friday's jobs report, if we get Friday's jobs report. That's the scorecard on Wall Street. Winners stay late. Welcome to Close Bell Overtime. I'm John Ford. Morgan Brennan is off today, and shares of Electronic Arts are soaring. The company's going to go private for $55 billion. We're taking a closer look at one of the buyers, Saudi Arabia's Public Investment Fund, which is making a big move into video games. And we'll be talking to the CEO of Wheaton Precious Metals, as gold, silver, and platinum have all been soaring recently. Now let's start with the markets as the Nasdaq's rising for the second straight day, even as whispers about an AI bubble grow louder. Let's bring in senior markets commentator Mike Santoli, who I believe has caught his breath from the end of the last hour.
Plenty of time, yeah. I think these are some of the right questions to be asking about an AI bubble. It felt like a crescendo last week when there was report after report and all these headlines, OpenAI talking about hundreds of billions of dollars in incremental investment. I don't think the market behavior or just the general setup is to a point where you'd have to say we have this unstable, disorderly rally that's going to create bubble conditions. But I think it makes sense to be attentive to valuation, be attentive to the premises under which you're operating for why you'd want to pay this much for these businesses, and then just try to read the market action for signs that things get either overheated at times or even volatility rising along with stock prices, which is sometimes what happens in the final blow-off phase.
I think sometimes the danger is to look at history and expect things to repeat. And we can look at the stock market today and say, well, it's not really like the market before the dot-com bubble. People aren't spending ridiculous amounts of money on companies that have no revenue. But I guess one could argue that it's kind of like what set up the financial crisis, right? People borrowing money to buy real estate that they really couldn't afford. People might be borrowing money to buy data center infrastructure that they can't use quite as soon as they'd need to be able to justify this expense.
The debt piece of it is definitely a growing issue that you have to watch, right? So it was before, it was like, oh, these 5 or 6 hyperscaler platform companies have the money in their pocket literally to spend on this. Now it's like, $100+ billion in debt, I think, by tech companies being raised at this point year to date. So I do agree with that. There's also this focus on how data centers, the key assets within them, of course, being the semiconductor piece of it, how fast they depreciate, right? The next generation is just that much better, and they theoretically, and so it's real assets. It's a building, and it's actually this operating thing, but it's something that you're going to have to constantly replenish. So I get it. I think in the near term, Morgan Stanley was out saying, look, whatever OpenAI manages to spend through all this, if they raise the money, if they have the power, it's not in any of the earnings estimates yet. Like, it's just basically all on the come. So I think it's hard to persuade people to back away from a sector when, in theory, the earnings numbers are still going to be going up. So I agree with the general premise, though. Don't expect it to go like the last time, because whenever I hear people say, hey, it's not like the peak of the NASDAQ in 2000, all that tells me is, oh, guess what? Then we're not poised to go down 75% in the next 2 years, because that's what happened in 2000 into 2002.
I was in Silicon Valley during the dot-com bust, and it felt like real economic disaster. But I would find when I would come to the East Coast, people were kind of like, oh, yeah, that's too bad. I mean, they felt it, but not like they felt it out there. And then the financial crisis, inversely, didn't feel quite as bad in Silicon Valley, perhaps because we had just come out of the dot-com bust and tech was starting to be vibrant again. Do you have a sense of what pieces of the market are perhaps less exposed to this AI thing, or is it the whole market, given how big the large caps are?
I don't think the whole market. I would say maybe the whole index. I don't think it's the whole economy. I mean, the index is very, very, excessively geared toward the AI revenue stream. I think there's a piece of it that's hard to isolate, which is the counterfactual. Let's say we didn't get the AI excitement coming when it did. I mean, these companies would be doing something with the money, presumably. There would be investments in some areas. Maybe something's getting starved because everybody's focused on generative AI. I do think the financial sector in general, it seems okay, right? They've kind of been prevented from getting into a whole lot of trouble. Maybe that's going to change in the next couple of years. But right now, it feels as if the actual systemic underpinnings seem okay.
All right. Mike Santoli, see you in just a bit. The S&P 500 is tracking for its 5th straight positive month. That's its longest monthly win streak since September of 2024. So should investors expect more gains ahead despite all these headwinds? Well, let's ask G Squared Private Wealth CIO and CNBC contributor Victoria Green and Northwestern Mutual Wealth Management Chief Investment Officer Brent Shute. Guys, welcome. Victoria, it's been a really good September by historical standards, unless tomorrow's a disaster. So assuming it's not, should investors stay long risk?
Yes, we're advising staying long risk because we don't fight the Fed, we don't fight the tape, and there are three things going for this market. Technically, the technicals are strong. Yeah, we're near-term overbought, a little bit, maybe messy in the next couple of days, weeks, but good, strong, long-term technicals. We have seasonality. Q4 is one of the strongest. The Santa Claus rally typically always works. Not always, but is a very strong season. And then number three is historical. When we've had performance like this, historically, new highs beget new highs. And so we look at that, we put it all together. I say, yeah, nothing's cheap. I understand that. Yes, there are some geopolitical risks, but kind of put your earmuffs on because government shutdowns typically don't mean much to markets, don't have a lasting impact. In fact, 4 of the last 6 times the government had a shutdown, the market was positive. So I look at all of this and say there is a case to be long risk assets. And if we get a dip, the likelihood it gets bought before it even goes down 5% looks really high to me.
Brent, at the same time, there's a decent chance we don't get jobs data at all on Friday if we get a government shutdown. So given the uncertainty that we've been dealing with overall and data coming in a couple different ways and how the Fed's concern had shifted to the labor market, how should investors compensate for the lack of data if we lack it?
Well, I think investors should remain diversified, not concentrated. To me, there is quite a bit of uncertainty, and I think the market is overlooking that. Think about this. We have average job growth less than 30,000 in the last 4 months, and yet no one believes there is going to be any chance of a recession. At the same time, you have inflation, which has been stuck around 3% for 21 months right now. The Federal Reserve hasn't landed at 2% for 5 years, and they don't expect to for the next 3, and yet no one thinks inflation's a risk. And then kind of on top of what Victoria said, the CAPE ratio is at the second highest level since 1999, and the second highest level, I should say, in the last 150 years. And people have this unbridled belief that they're going to know exactly when valuation, which has worked historically, will begin to work again. They think they know when it's going to be time to maybe move out of some of those areas. And so to me, I think there are quite a few risks that are out there. That does not mean that you shouldn't be invested. It just means that you should stay diversified because I think there are myriad outcomes here. And that's why I would encourage people to look at valuation, look to other parts of the economy and other parts of the market that haven't done as well, which are small and mid cap and the average U.S. stock. And that's where I think, at least historically, you've seen broadening out from these narrow markets, which I think you will in the future once again.
Victoria, you mentioned that historically a shutdown isn't something to worry too much about from an investor perspective, but are there aspects of this one that could be different? The potential for permanent government job cuts, the timing here with us not getting as much insight into data at a time when things are shifting. Is there anything that you're watching for potential concern, even though historically it hasn't been?
Yes, obviously this one could be a little bit rougher than ones in the past. If we're not seeing furloughs, if we actually see mass layoffs, obviously that doesn't help anything on the labor market there. As well as I will freely come into this saying, look, Trump has a lot of geopolitical capital. He has a lot of wins banked. The potential he's willing to go a little further to the brink to push things a little further to get what he wants. I do see that also as high because when you have that kind of political capital, you've got these wins he's notched under his belt this year, then that makes him a little bit more emboldened to potentially take a stronger stance against and to look to get what he wants and not have to cede anything to the Democrats. I mean, if you look at the betting markets, they're saying about 75% likelihood of a shutdown. Historically, shutdowns only lasted a couple days, maybe 2 weeks. This one could be a little bit on the nastier side just because of the composition of government and kind of the dynamics of power play here that could definitely make it seem a little bit harsher, which could then obviously have a little bit more of a market reaction, as well as valuations are extremely high. So we're susceptible to kind of selling bad news anyway. So this just kind of leaves me to saying could be a dip, could be a pullback, but likely not long lasting.
Finally, Brent, you see particular risk in large caps?
I just think valuation matters. And to me, the whole conversation that we just had, or you just had about is it 1999 or not again, there are similarities there and there are echoes. And I do believe history repeats because we are the people who write history. The people who are listening to the show, Victoria, you and I, we're the economic agents as well as the people who invest in markets, and we're all behaviorally flawed and have been for hundreds of years in many of the same ways. And so to me, I think the market needs to broaden out. It has after every time it narrowed, which is usually at the end of an economic cycle. And that's where I think investors should pay heed to that and think about making sure that they own things other than those AI stocks, which is where at least a lot of investors I talk to want to just concentrate because it's been the only answer the past few years. I think that will shift once again in the future, and there will be new leaders going forward.
Okay. Brett, Victoria, thank you. Well, at the end of the day tomorrow, that's less than 32 hours from now, the government could shut down. There are signs that this time the consequences might be more severe than previous shutdowns. Let's get to our Emily Wilkins for the latest. Emily.
White House right now for a high-stakes meeting with President Trump. There's an increasing sense in D.C. that right now we are hurtling towards a shutdown. The White House might really be the last chance to kind of pump the brakes, see if they can reverse that momentum. But at this point, their meeting's still going on. There are no cameras in the room, so it's not clear exactly at this point what kind of progress is being made. And just remember, as they went into this, Democrats, they're looking for something on health care, specifically when it comes to addressing the end of those premium tax credits that would have otherwise kept prices low for the millions of Americans who get their insurance through the Affordable Care Act's marketplace. But Republicans say that is a discussion for after the government's already funded. And one of the things we'll be looking for here, if Trump weighs in on what he wants to see with these tax credits, if he's concerned that insurance might be rising for Americans. Meanwhile, we are getting a clearer sense of what is going to happen in a shutdown situation. Bureau of Labor Statistics confirmed that there will be no jobs report on Friday if the government is in a shutdown at that time. And remember, data collection is also going to pause during a shutdown. That could mean upcoming data on jobs and consumer pricing won't be as accurate if this shutdown goes for a couple weeks. Not to mention, as you and the guests were just discussing, a large-scale federal layoff could have a lot of very serious impacts. It could be hundreds of thousands of federal employees that could be set to lose their job. Now, the Senate is set to vote again tomorrow on continuing current funding levels until November 21st. Remember, if you math the math, they're going to need at least 7 Democrats, maybe 8, given that there's at least 1 Republican expected to vote no. The Democrats would need to join them to pass a bill. The House is not planning at this point for coming back for votes until next week, which means that if the Senate is unable to get things done, we're really going to be stuck in a position where we could be in a shutdown for at least a couple days, if not more. John?
Emily, the sense that I had gotten up to this point is that the Democratic leadership might be determined to show their base what might appear to be more of a spine this time than some previous incidents, and therefore, play this game of chicken and let the government shut down despite the impacts. Is there any reason to think that they, in particular, won't do that, or significant voices that would vote to keep the government open while conversations continue?
Look, John, at this point, everything that Schumer has said publicly, everything that Hakeem Jeffries has said publicly has basically been doubling down that they want something on health care in return for their votes to support this stopgap and prevent a shutdown. Now, of course, we have heard that there are other conversations going on, suggestions about what it would take for Republicans to give them to be able to keep the government funded. We are beginning to hear some reports of potentially a shorter term stopgap. So instead of something going 7 weeks, maybe something going 7 days. But I was just in a group of reporters speaking with Senator John Barrasso. He's the number 2 on the Senate Republican side. He basically threw some cold water on that idea, saying, look, the vote that they're going to take tomorrow is the bill that the House passed the other week ago to keep the government funded until November, and that's what they're planning on going forward with at this point. It'll be very interesting to hear what Schumer says when he comes out of this White House meeting, if his posture does change at all. What I can say is that while Democrats are definitely ready for a fight this time, more so than in March, there is some serious concerns that they are going to blame if there are large-scale federal layoffs, and a lot of them are concerned about what that could mean. It just doesn't seem like this time that those concerns are outweighing the need to show their base that they are willing to fight and push back against some of the things that Republicans have implemented.
Maybe we'll have to see the polling who likely voters blame. Emily Wilkins, thank you. We'll see. Well, coming up, tech stocks up again after a brief pullback. AI-related names are once again soaring. We're going to give you the name of this mystery stock. It's not in the Mag 7. It's tripled since February. And we'll talk to an analyst getting bullish on Lam Research, with demand expected to increase thanks to AI and China. Overtime's back in 2.